Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. Let's take a look at the stories for the day.
रामू दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का home loan. I agree with you.
SBI is the banker to every Indian.
Paytm has been in the news for a while now. A few months after its IPO shook investors' confidence in the primary market, a recent audit has shaken the RBI's trust in the implementation of its Know Your Customer norms. But are all financial institutions adhering to the KYC norms? And what difficulties do they face in implementing them? Watch our next report to find out more.
On March 11th, the Reserve Bank of India barred Paytm Payments Bank from onboarding new customers with immediate effect. Without elaborating, the RBI said it observed material supervisory concerns in the bank. The regulator also ordered a comprehensive audit of Paytm Payment Bank's IT systems. Vijay Shekhar Sharma holds a 51% stake in the bank and 197 Communications 49%. The restrictions mean users cannot sign up for new Paytm wallets or Paytm Payments Bank savings and current accounts. Meanwhile, sources told Business Standard that RBI's action was primarily owing to violations of KYC and anti-money laundering norms. The bank faced a similar action in 2018 after RBI found that it had violated KYC norms while onboarding users. Banking industry experts said the RBI had been strict in this regard in view of the Financial Action Task Force country review, which is coming up this year or early next year. Paytm has denied a news report from Bloomberg that said RBI found Paytm Payment Bank's servers were sharing information with China-based entities that indirectly own a stake in the firm. In the past, RBI has levied monetary penalties on banks for non-compliance with KYC rules. Earlier this month, 3 cooperatives faced penalties, while in September 2021, Axis Bank was fined 25 lakh rupees. Recently, fraudsters used the PAN numbers of several people to avail instant loans from the Dhani app. This has highlighted the need for stronger KYC checks. The objective of KYC and AML guidelines is to prevent banks from being used by criminal elements for money laundering. KYC procedures also enable banks to understand their customers and their financial dealings better, which in turn help them manage their risks prudently. Banks must ensure that no account is opened in anonymous or fictitious names. An account should not be opened when a bank is unable to apply appropriate customer due diligence measures, either due to non-cooperation of the customer or non-reliability of the documents and information furnished by the customer. Customers shall be categorized as low, medium, and high risk category based on the assessment and risk perception of the bank. So, what are the challenges that financial institutions face when trying to implement RBI's KYC and AML guidelines, since lenders are being frequently fined for lapses?
What do you mean by knowing your customer? One is, who is the true identity of the customer? Who are the beneficial owners of that accounts? Why is he opening an account? What is the source of fund? And what constitutes something called, we call it in our parlance as the reasonable account activity. This information should be collected and also verified. Digital transactions, which has picked up specifically in COVID, lockdown, etc. Right? However, these innovations could probably also have introduced certain new vulnerabilities and complexities into the overall ecosystem. So what the institutions need to focus on the real question: are my systems, the backend systems and processes and framework that have been put in place effective and in line with the changes that have been made at the front end, especially when I'm introducing a new product or a technology? The second is, are the banks aware of the possible new money laundering trends or techniques, and are any steps being taken to prevent them? The second most important aspect is obviously your transaction monitoring. With this increased volume in COVID of digital payment, the changing pattern of customer behaviors, and the new emerging risks that are detected Are you able to identify the red flags using the traditional transaction monitoring solutions? Is a question which we find that is becoming increasingly difficult for many of the financial institutions. So at the end of the day, if you don't have effective controls, your AML controls framework will not be really effective. Whether you like it or not, compliance is not an option. So whatever is the cost, you'll have to incur that cost. That's number one. But what also banks needs to look at is how are they actually implementing it? And to answer your question, yes, the costs have gone up.
In an increasingly digital world, it is clear that banks must find innovative ways to assess customer risks and monitor transactions. Financial institutions, that is both banks and fintech companies, should understand the complexities that arise from both the volume of transactions as well as the volume of KYC data as we undergo a digital transformation.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
KYC cuts the risk of fraud in digital transactions, the nature of which has changed quite a bit in recent years because of the pandemic. UPI is set to grow bigger now with the RBI introducing it in feature phones as well. Most other forms of digital transactions are also growing. Our next report provides an insight into the changing landscape of virtual transactions.
Last week, India's central bank finally rolled out the Unified Payments Interface for low-cost feature phones. With this move, the RBI aims to bring at least 400 million people into the fold of digital ecosystem. Now, people who don't have a smartphone will be able to transfer money using the UPI feature. The new feature is the third iteration of the Unstructured Supplementary Service Data (USSD) service launched in 2016. It is expected that the new feature will onboard more users and help UPI cross the 10 trillion rupee monthly mark. Value of UPI transactions have increased, but volumes have increased faster. The need for the new service arose because despite transaction volume for digital payments growing, transactions from USSD service were declining. In February, 14 crore rupees worth of transactions were done using the USSD service, way lower than the 21 crore rupees value achieved in January of 2019. USSD is a message-based service where a person can transact using a feature phone by dialing *99#. On the other hand, the growth in immediate payment service or IMPS, another NPCI payment service, was faster than National Electronic Funds Transfer or NEFT. IMPS transactions growth in value was almost 2.5 times higher compared to NEFT. IMPS transactions averaged 2.48% increase monthly for the last 12 months compared to 1.01% for NEFT, indicating a growing acceptance for faster money transfers. Transaction volumes grew even faster than the value. Let us now see how cards have performed. Credit card usage at online channels was higher while debit card usage at point-of-sale devices increased again. Its share of online transactions declined. In November 2019, every second transaction via credit card was at a POS terminal. The ratio declined to just over 1 in 3 transactions. On the other hand, 2 out of 3 times debit cards were used at POS terminals. Meanwhile, wallets have also made a comeback with rising transaction volumes. Wallet transactions were consistently above the 200 crore rupee mark between October and December last year. Even though digital usage is growing in absolute terms, a business standard analysis shows that digital transactions have declined as a ratio of the gross domestic product or GDP. In 2018-19, the ratio was 8.7. It dropped to 8.1 in 2019-20, and in 21-22, it is expected to fall further to 7.1. A reason for the decline is rising demand for cash. Another significant reason is the absence of big-ticket transactions during COVID. So it remains to be seen whether transactions will zoom again once the economic trajectory improves.
यार मत पूछ यार, फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर। इसमें बहुत तामझाम है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Digital transactions also form the backbone of financial markets. Global stock markets, meanwhile, seem to be waiting for the outcome of the two-day meeting of the US Federal Reserve on March 15 and 16. Business Standard's Puneet Wadhwa spoke with Raamdeo Agrawal, co-founder and joint managing director of Motilal Oswal Financial Services, to know how he is interpreting the situation in Ukraine, the impact of other recent developments on corporate earnings back home, and the investing opportunities in this market correction. Let's listen in.
Hello, Mr. Agrawal. How are you?
Very good. Thank you. Good afternoon, viewers.
So let me start by asking you, are the investors being given an opportunity of buying their favorite stocks lower amid this geopolitical crisis, and they're not realizing it yet?
Yes, I think despite intense selling by global equity markets, more particularly in India by the FIs and all, still the correction has been quite modest. I mean, that has been surprising to everybody that from the top, we're just about 9-10% down, at least at the index level. Some individual stocks must have corrected by 30, 40, 50%. But there is a correction. And I think people who are sitting on the fence a few months back, of course, this wartime was one opportunity. But generally, this kind of war and global disturbances, they used to bring much more kind of correction, deeper correction, 20%, 30%, like what happened in January 2020 when COVID got hit. So straight we got 40% correction. And this time corrections have been much lower thanks to the domestic buying, very strong traction. That has what has kept them. But I think people are, kind of coming out, not very aggressively, but they are selectively buying the corrected stocks in the portfolio.
So do you think it's time to be greedy or fearful?
No, definitely not fearful. When the world is fearful, you have to be greedy. But how greedy? Because since they are corrected only 10%, so itna bhi kuch antar nahi padta. In the sense that, I mean, yes, you have to. It's a healthy atmosphere for investing. Market has corrected. You are looking at about 19-20 times next year in a peacetime zone. So clearly, these are times to for the stock pickers, and you must start building portfolio. And if you are sitting on the fence, you start getting into the market slowly, 5%, 10%, 15%. You start putting in the markets. That's because nobody knows the future. I'm not saying that I know the future and we can risk, we can price all the risk. But at a price, I mean, and whatever is known, everything is in the price. And it is very resilient. We have seen most of the FI selling. And actually, at one level, entire emerging market has collapsed. So there are 4-5 countries in emerging market. The biggest was China, second was Taiwan, third was India, fourth was I think Russia and Indonesia. Usme like China, Taiwan, and Russia, 3 are out. I mean, it has become uninvestable by the, capitalist countries like US and Europe and things like that. When they come in, when they want to buy back India again, I think they have to buy India separately instead of buying as the emerging market basket.
Foreign investors have been selling relentlessly, and the domestic institutions and the retail investors have lent some support. At what point do you think that they will also throw in the towel?
Domestic investors, my sense is that it becomes cheaper. See, if the selling continues relentless, so earning. See, the thing is the pickup in the economy. If the economy picks up, if the war subsides and everything, because see, there were 2-3 big events which happened. One, the elections is behind, and it has happened absolutely for the stable power. Okay, so that gives. So there is a stability in the politics side, which is not a small thing for India. Second, your COVID is completely over. We are done and dusted. So these two have not been celebrated. Clearly, the price of the war has been quite heavy. Now, when we go forward, the war will someday get over in next 1 week or 10 days. or whatever, and it becomes peaceful time, and election is already over. So what will happen is 22-23 looks to be a much better year for the earnings.
When do you think that inflation concerns, geopolitical concerns will start chipping away into the puppet earnings growth for FY23?
Yeah, so what is happening today, if it gets prolonged, see, 15-20 days can always be sustained in the sense that very quickly from $130 oil just come down to say 100. Now it comes down to say 85, 90. That's what earnings were built around. So, I mean, even 85, 90 is not very comfortable number, but I think this is a new normal in terms of you're looking at closer to $100 oil price than 70, 75 kind of a comfortable situation we had. Because another side, USSR is part of OPEC plus, and OPEC is not going to, I mean, they have some kind of alliance force. So they're not willing to pump too much of extra oil to cool down the oil prices. They're more kind of with Russia in terms of controlling the oil volumes in the market. If the oil is stabilized at 75, 80, 85 in some kind of a narrow band, then all the passing through and normal working of the corporates will start. I mean, I'm buying oil as an oil refining company on behalf of customers.
So what is on your shopping list in terms of sectors and stocks? And any contrarian bets?
See, I think wherever the manufacturing is hurt because of this oil crisis, I think that's where the deepest cuts have happened. Like cement companies, oil companies, all the manufacturing companies, they've been cut very deeply. So you have to go and figure out where the cut is going to be permanent, whether the cut is going to be temporary, and how does it, I mean, how essential is the product in the marketplace, and see their assess the impact of the changes right now. So I think that's where some of these things will come. Because of the FI selling, banks and tech, Indian tech, both are doing very well. I don't have any doubt. Both are services, so they're not impacted by the current war impact, basically. And both of them were to do well even before COVID. And now it looks that their prospects are intact and they will do well. Now the issue is that has the correction been deep enough for you to find value in them? Definitely in banks, the values are much more visible than in IT. IT has corrected just about 8-10%, but mid-cap IT has corrected a lot more, which can grow at 15-17%, 5-10% higher than or 2x to the big giants like Infosys, TCS. They could grow at about 10-12%, but smaller companies can grow at 18-20%. So the valuation differential was somewhat very high, and there the correction has happened in the mid-cap stocks.
Thank you, Raamdeo, for this valuable advice. We hope to see you soon.
Thanks.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After markets, let us return to the subject of digital transactions. National Electronic Fund Transfer, or NEFT, is now a preferred mode of transactions. The RBI-managed NEFT has made near real-time movement of funds from one bank to another very easy. But how does the NEFT system operate? Let's find out.
The National Electronic Funds Transfer, or NEFT, is a nationwide centralized payment system owned and operated by the Reserve Bank of India. The objective of NEFT was to establish an efficient, secure, and economical electronic fund transfer system. NEFT is now available round the clock on all days of the year. Before December 2019, NEFT transactions were settled between 8 a.m. to 7 p.m. on weekdays and from 8 am to 1 pm on the first and third Saturdays. The system remained unavailable on Sundays and bank holidays. The electronic system offers near real-time funds transfer to the beneficiary account and settlement in a secure manner. The RBI does not levy any charges from member banks for NEFT transactions. On credit to the beneficiary account, the remitter will receive confirmation via SMS or email. Besides funds transfer, NEFT system can be used for payment of credit card dues to the card issuing banks, payment of loan EMI, inward foreign exchange remittances, and more. It is also available for one-way funds transfers from India to Nepal. But how does the NEFT system operate? An individual or an organization willing to transfer funds through NEFT can use the internet or mobile banking facility by initiating the transfer request. The remitter has to provide details of the beneficiary and bank account for the addition of the beneficiary to the internet or mobile banking module. Following beneficiary addition, the remitter can initiate online NEFT funds transfer by authorizing debit to his or her account. Alternatively, the remitter can also visit the bank for initiating NEFT funds transfer. Following this, the originating bank prepares a message and sends the message to its pooling center, also called the NEFT Service Center. The pooling center forwards the message to the NEFT Clearing Center, operated by the RBI, to be included for the next available batch. The clearing center sorts the fund transfer transactions and prepares accounting entries to receive funds from the originating banks and redirect them to the beneficiary banks. Thereafter, remittance messages are forwarded to the beneficiary banks through their pooling centers. While the RBI has not imposed any limit on the amount that can be remitted through NEFT, banks may place limits based on their own risk perception. The beneficiary banks receive the inward remittance messages from the clearing center and pass on the credit to the beneficiary customers' accounts. A person having no bank account can remit funds through NEFT to a beneficiary having a bank account. It can be done by depositing cash at the NEFT-enabled branch of any bank. Such cash remittances are, however, restricted to a maximum of 50,000 rupees per transaction. NEFT presently operates in batches at half-hourly intervals throughout the day. In case of non-availability of NEFT for any reason, appropriate messages are broadcast by RBI to all system participants. With effect from January 1, 2020, banks have been advised to not levy any charges from their savings bank account holders for NEFT funds transfers initiated online. The maximum charges for outward transactions at originating banks for other transactions have been prescribed by the RBI. The remitter and the beneficiary can track the status of NEFT transactions by contacting NEFT Customer Facilitation Center of the bank. The beneficiary customer receives the funds only after final settlement takes place between the banks.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
A recent report suggested that an increase in transactions on the UPI platform could shift business away from NEFT. The share of NEFT in retail credit transfer has recorded a fall of over 8% in a year. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.